This is Financial Algebra, and we're going to start here in Chapter 2 on banking services. Okay, so I've got a schedule here for you. We're going to talk about checking accounts the first day. We're going to talk about reconciling checking accounts the second day. Day 3, we're going to talk about savings accounts. We're going to talk about simple interest and the arithmetic sequence formula. Then we'll talk about compound interest. These will be really, really important lessons. This compound interest stuff is stuff you want to know. It'll make an impact on you in your life. Continuously compounding interest, that's a good one too. Then we will have, during our asynchronous time, I'll give you a review sheet for the test, and then we'll take a test on the 5th. Okay? So, with that in mind, let's get to it. So, checking accounts. What's a checking account? A checking account is an account that you can use to transfer funds to other people or businesses. Okay. So payee. What is a payee? Well, you've got a payer, which if you're paying a bill, you are the payer. The payee is the person receiving the money. So the payee is the person receiving the money in a transaction. Check clearing. Check clearing. Okay, so when you write a check, you basically give a piece of paper that has no value to somebody. They have to take it to their bank, which there's a good chance it's not your bank. Okay, and they deposit that in their accounts, and then the bank has to send that to a clearinghouse, which gets sent to your bank, which tells them, hey, send this money to this bank account at this other bank. And so that takes time, okay? Although it's a lot faster than it used to be, it can still take a couple of days to get that done. So check clearing is the process involved in transferring money from your account to the payee's account. Via check. Now, there's other ways that you can do it. You can do electronic funds transfers, which are much quicker, but if you're using a check, then that's the check clearing process. Direct deposit. Okay, direct deposit, which most employers do now. There's hardly any that'll write you a check. Usually you get a check, maybe your first paycheck, sometimes your last paycheck. But in between, they want to set it up on direct deposit because they can do it quicker and easier and cheaper. So what is direct deposit? Direct deposit is, I don't know what happened there. When your employer electronically deposits your pay directly into your account without a check. That is a direct deposit. What is an ATM? An ATM is just a machine that accepts deposits or dispenses cash. So you can do your banking at a machine instead of have to go into the bank, which is very convenient many times, especially if you have to do your banking. You know, some people have jobs where they work in the evening, or they're available in the evening, and the banks are already closed. So they have to do their deposits at an ATM if they want to do them in a timely fashion. Okay, your PIN number. Your PIN number is just a number, usually 4 digits, that grants access to your account. And you should not give your PIN number to anyone. Okay, not a good idea, because once they have your PIN number, you know, they have your card, boom, they're in. Okay, they can move your money around whether you want it or not. What does it mean to endorse a check? Okay, so to endorse a check, what that means is, like, if I make out a check to you, you're the only one that can deposit that check, okay, or cash that check, unless you endorse it. So endorsing a check means that you sign your name on the back of the check, and that allows others to complete a transaction with that check. Okay, a lot of times a bank, if you go to deposit, they'll ask you to endorse it. So basically what you do is you flip it over, and on the end it's got a space that says endorse here, and you sign your name to it, and then you can deposit it into the account. Okay, so like when I was a kid, I worked for my dad in his grocery store. He would do payroll on Friday, and he would write out a check to me, and then he would always write on the back where you're supposed to endorse it for deposit only into account number, and he would write my account number on there, which that account number, I didn't have, it was my account, but I couldn't take any money out of it. Only my mom could. So kind of had a forced savings. So you got to be careful if you endorse a check, because then anybody can technically cash it. So yeah, just be careful and aware of that. Insufficient funds. Okay, this is something you don't want to hear. What does it mean to be insufficient funds? That means that you wrote a check and you don't have enough money in your account. Okay, so insufficient funds means that you wrote a check for more money there is in your account. It's also called bouncing a check. And if you do that, your bank's going to charge you an additional fee. So, if you had 20 bucks in your account and you wrote a $30 check, okay, you don't have enough money to cover that, your bank's going to probably charge you another $30 on top of that because you bounced that check. Okay, and you can get hit for fees from the person who accepted the check and the person who deposited the check. And yeah, you want to make sure that you got enough money in your account so that you don't get insufficient funds. Overdraft protection. Okay, this is kind of your get out of jail free card with insufficient funds. So overdraft protection means that the bank will cover a check with insufficient funds. Okay, now sometimes what they'll do is they'll attach another account, a credit account, to your checking account so that you wrote a $100 check and you only had $50 in your account. It will take $50 from your credit account and put it into your checking account, and it will cover the funds that way. Sometimes they'll charge you a fee for that, sometimes they won't. It depends on what kind of account you have and what bank you're at. But still not a good idea to do this. You don't want to have to use overdraft protection. But it is kind of convenient if an accident occurs, and accidents occur. I mean, most people will bounce a check at one time or another, and it doesn't mean that they did it on purpose. It just happens. Especially if you have a joint account. Okay, what's a joint account? That's just an account that more than one person can access. Okay, so usually married couples have a joint account so they can both access the money. Not always, but most of the time. Sometimes, like my parents have my sister on their account because it's convenient for them they're getting up there in years, and it's convenient for them to have somebody else that can do transactions for them sometimes. So you just got to remember that if you have a joint account with somebody, they can access your funds whenever they want to. So you got to make sure that that's somebody that you trust. Okay, debits and credits. So a debit to your account means that you are taking money out of the account. Okay, so let's write this as a transaction where money leaves your account. And then a credits are the opposite of that. A transaction where money enters the account. Okay, we're going to take a pause here on this video and make sure that you have your notes all caught up with this. And If you have any questions, write those down so that you can ask me once we're back in asynchronous time.